The fragility and the potential exposure to crisis in the world has actually increased, and the policy options to deal with it have decreased. And I think that's a very strong message in this book. When the crisis hits, what could one do? And it says, well, don't trust that someone else is going to do it for you. Because it says the international mechanisms that one could think of to deal with them, whether it's in the IMF or in multilateral organizations, the international mechanisms are totally inadequate to deal with a major crisis and the fallout on your country. And it doesn't matter which country, just any country.
For The Real News, I'm Lynn Fries in Geneva, and those clips were part of a commentary on Playing with Fire, featured in part 1 of this program. In this segment, we feature another commentary on Playing with Fire, this one by the author, Yilmaz Akyuz. A prolific writer, currently as Chief Economist at the South Centre, and in his former post as Chief Economist at UNCTAD, where as lead author, he wrote the Trade and Development Report, among other seminal works. Playing with Fire is Dr. Akyuz's most recent book release. We go now to the UN Geneva and our featured event.
I wrote the book before I read this very remarkable piece by Deepening and Anun. I use a lot of material from BIS. I also see common references between the two books to BIS work. For instance, how financial crisis distort income distribution, or boom-bust cycles distort income distribution and resource allocation. Again, how monetary policy in the US and elsewhere is leading to debt accumulation. What I try to do in the book is to look at the sustainability of the situation. This required in-depth analysis of taking the good picture of the state we are in. And that required a lot of data collection, and it was one of the most difficult work I've done, with a lot of support. So I needed all that data to analyze why the situation would not be sustainable. The basic idea was that after a series of crises in the 1990s and early 2000, from Latin America to Europe to Asia, developing countries integrated more and more with the international financial system. In the new millennium, I asked how, why? Why is it that we were starved of funds in 2000, 2001, and suddenly we were flooded? That was the nature of international capital flows, of course. I saw two things. One is US monetary policy. As Littles make very clear in their book, monetary policy in the US has been progressively looser since the 80s in search of economic growth. One of the main reasons is that because of inequality in income distribution. Inequality in income distribution is creating an effective demand problem. And there's an effective demand problem, there is very little investment. So wages lagging behind productivity growth, and also allowing monetary expansion without fear of inflation, because inflation often comes with the wage push. So the US Federal Reserve has been bringing down real interest rate, and as the chart in the Hanon Little's book shows, as interest rate comes, G7 debt is going up. And I can show that third world debt is going up too. And every boom is ending in a bust, and every boom-bust cycle is making it worse by distorting income distribution and resource allocation, and therefore requiring even bigger bubble. After the 80s saving zones crisis, US cut interest rate almost to zero at the beginning of the 1990s again. After dot-com bubble, they got, again, creating subprime bubble, and now they're going to the negative territories. So after every bubble bursting, you need a bigger bubble to keep momentum. Now, why are developing countries liberalizing? I think that a couple of things. One, it's very difficult to resist the wind. There is diversity. But even India sort of had some liberalization, and it wasn't, if it wasn't the Asian crisis, India would have liberalized earlier. If it wasn't the 2008 crisis, India would have liberalized more after Dr. already left the Reserve Bank of India. It's difficult. Particularly if you open on the trade side, investment side, you cannot really close easily on the finance side. This is difficult. Second, money coming in, a lot of it coming in, has encouraged you to liberalize so that some of them can go out. Even India did it. Rather than trying to block the money coming in, you allow your residents to take money out, encourage your corporations to take money out. That's fine. But the problem is that when the foreigners go out, that money will not come back. These governments are short-sighted, not just the corporations. And therefore, conditions of considerable amount of liquidity, very low interest rate, government started liberalizing. Thirdly, actually they thought that they were liberalizing in order to reduce their vulnerability. Let me tell you how. First, they wanted to shift from debt finance to equity finance, because equity finance is less risky. So they opened stock markets to foreigners. They liberalized foreign direct investment regimes. Second, they all suffered from the exchange rate risk in Asia, elsewhere, in the emerging market crisis. And they said, we don't want this exchange rate risk. What do? We borrow in our own currencies. So let's open our domestic bond markets to foreigners. They did open. And what happened is, sovereign debt in many emerging economies today is internationalized a lot more than the US treasuries. 1/3 of US treasuries are held by China, India, and Japan. 60% of Turkish, Peruvian, etc. treasuries are held by non-residents. And our treasury is not held by central banks as reserve. They're held by asset managers, by fickle investors. So we try to solve one problem, we created another problem, losing control over domestic bond market interest rates. We allowed foreign banks in. The share of foreign banks in developing countries, except Latin America, has increased significantly. Why? We believe that they bring competition, they reduce intermediation margins, reduce the vulnerability to external financial shocks. But as Dr. Reddy explains, that one of his main concerns when he was dragging his feet against the foreign banks was that they make regulatory arbitrage and make it very difficult to regulate the banking sector. And what we saw in Asia was that foreign banks acted as instrument of transmission of crisis in Germany and France to Eastern Europe, drying out resources in Eastern Europe to help their parents in Germany and France. Banking regulation has improved, no doubt about it, in the South. But now banks are much less important in intermediation of international finance. Money goes directly to securities market or bond issues has become more prominent than international bank lending. So after all this, we have an increased financial fragility. Our local investment base is very shallow, except countries already graduated like Korea. Bond market, equity market is highly susceptible to foreign influences. We had the so-called low-income countries, LICs, the frontier markets, going to international capital markets for the first time, issuing bonds, benefiting from low interest rate and high liquidity risk appetite. The amounts are small, 5 billion in some cases, but large with respect to their income, their export earnings. And already some of them started defaulting on their Eurobonds. As Dr. Titus explained, I discussed the so-called measure that increased the resilience of the European countries, the moving from fixed peg to floating. I say that fine, but no exchange rate regime is infallible. Crisis can happen under fixed or the floating. And at times of crisis, whether you're floating or fixing doesn't help, it goes down freefall. Risk of sovereign debt crisis has diminished significantly. And the next crisis in the South most probably will be a private sector debt crisis. But after every private sector debt crisis, sovereign debt increases significantly. We've seen it everywhere. Look at Spain, pre-crisis public debt ratio was 30%, now it's 100%. And the crisis was largely to private borrowing. Finally, I discussed this much commended reserve accumulation. Now in the 90s, when Asian crisis happened, Korea had $100 billion short-term debt, $30 billion reserves. They said we didn't have enough reserves to meet the short-term debt. Now we have enough reserves to meet the short-term international debt. But the short-term is 1990s story. Today, everything is short-term. Bond holdings, equity holding, deposits, and even foreign direct investment. This is what the book is trying to do. I examined the reserves vis-a-vis kind of a liquid liabilities and so on through the balance sheet for some countries such as Indonesia, Malaysia, etc. With a massive exit from domestic markets, none of them could stand. Now, of course, governments say that it won't happen. I hope it won't happen. But if the situation is not sustainable, it will happen. The world is addicted to cheap money and accumulated massive amount of debt. In some countries, public debt, in others, corporate debt, in others, household debt. In the South, we had mostly corporate and household debt. We had consumption and property bubbles. In the North, you had more fiscal debt. Public debt. And I was telling Richard the other day that in the FFT, if you want to discuss the public sector resources, you should start from the North because they have much higher debt. Their fiscal policies have much more important consequences for the global economy. And I believe in the event of a sharp downturn in the world economy, much of this debt can become unpayable, even without a significant rise in interest rates. I think in such a case we'll have a significant rise in risk premium, but maybe not the policy rates. Usually, Jan would know this better, US goes into recession after 18 quarters. Now, US has been expanding consecutively 27, 28 quarters. So recoveries also die, people say. So we might have a slowdown in the US, we don't know. And in that event, with the contagion, much of this debt can become unpayable. Of course, the normalization of monetary policy was significant turnout in global risk appetite can make the matters work. As Dr. Titus mentioned, this is all the more worrying because we do not have adequate international mechanism for effective and equitable resolution of liquidity and debt crisis. Developing countries all are sworn not to go to the IMF again in the event of a crisis, but I don't see what other options they have in the absence of international multilateral mechanism for debt resolution and resolution of liquidity crisis. I think I stop here.
We have to leave it there. Special thanks to Yilmaz Akyuz and to the South Center. And thank you for joining us on the Real News Network.